Hello and welcome to NDTV Profit. I'm Monal Sanghvi, and today we are going to catch up with the chairman of GIC Re, the sole public reinsurer of India. And well, the stock has outperformed quite a bit in the past 1 year. If we look at it, it's gone up from 135 rupees levels to a 373, hitting a high of 441 in February. So quite a lot happening on this front, and let's catch up with Sir to understand what exactly is going on behind the scenes. So the performance, like I said, we were looking at the 5-year performance, and I think we've gone from very low profitability levels, in fact, losses, to now come to profits. While on the revenue front, I'm still seeing that it's lower than the 2020 level, but we're somewhere regaining ground, right? So also on the premium front. So what's gone right in the past 1.5 year, and how do you view it going forward?
So thank you for having me, Sonal. And so we are on a journey. So 2020, you are right, our top line was possibly at the maximum. We wrote something like 52,000 crores of premium, but then we also posted a net loss. So basically, things have not been working great at that point of time. Since then, and I think COVID struck, we took that as a chance to, kind of recalibrate our business, have a good look at what we are doing, what is working for us. And over the last 3 years, if you see, we've actually degrown our book. So from 52,000 crores in 2020, we actually came down to 36,500 last year.
Yeah.
Right? So that was a significant degrowth. But then the good part is, it kind of images, gives us a reverse image on the profit front. Every time we have degrown, we've actually done better on our profits. It's simply because we have weeded out, businesses that were not working for us. Both internationally and domestically, we have weeded out substantially. And so last year we came out with really good numbers on the profitability front. We did almost 6,300 crores of profit. So I think now we are in a very good position where we are very comfortable with the book that we are writing. We believe this is the right time for us to now start focusing on growth. Our solvency, which was 1.53 in March 2020, has now grown to 2.94, as against the mandated 1.5, which gives us a good buffer of capital, which enables us to look for opportunities in the market and write good premium business. So again, India follows the April to March. So all the major renewals happen on 1st of April. We are currently talking to companies, trying to figure out where we can partner with them and do some good business. I think we are in a good space right now.
So if I had to break this down in terms of business, I think reinsurance is not discussed as widely. So, it's quite interesting to our viewers as well to understand now how does your book look? So, what sort of business lines do you look at, and which are the more profitable ones versus what have you now stopped underwriting, like you said, because you've done some corrective measures?
So if you look at the reinsurance book, first let me also clarify to viewers that reinsurance is a business-to-business book. So I don't do business with the retail public at all. I only provide support to the insurance companies. If you look at my book, 70% of my book is Indian business, 30% is international, because a reinsurer normally does not focus on business in only one country, unlike an insurance company. We normally do business across the world. Idea is to diversify your book, spread your risks, so that losses from one part of the world is getting returned or is getting paid off by premium from other parts of the world. So that is what we are looking for to get as much of diversification as we can. We write all classes of business in the non-life space, but that is domestically. Internationally, we try to restrict ourselves to short tail classes, which is the fire, the motor own damage, or a bit of engineering, a bit of marine, a bit of aviation. But we don't write the typical long tail classes like liability or motor third party and things like that, because honestly in the international markets that becomes very difficult to manage. In India, we write all these businesses, and we have a good, relatively good spread across all these classes. Basically, property is our biggest class, putting both international and domestic together. Another big class is motor. Third is health. Especially in India, health is really growing in a very fast pace. Fourth is agriculture, but that is one area where we are slightly less less up to speed, I would say, in writing that business, because we believe the market has really changed there. I think 2016, around that time when the agriculture scheme had come into the market, we had actually supported the market well. We had good experience of writing that business in the past, so we helped the market, in pricing, in risk management. But ever since, we have seen, pricing coming down. There have been catastrophic losses, so we've actually stepped back from that space. From agriculture, we are pretty lean on that today. But otherwise, most other classes we write well.
And so, out of these segments that you've mentioned, is property also the most lucrative one in terms of margins?
That depends. Property, the problem is the cat, the catastrophe.
Yes.
And today what has happened, and if I really look at reinsurance business over the last 6-7 years, maybe from 2016, catastrophes have really gone up. And maybe it's what we call as climate change. Earlier there was a time when we used to talk of climate change and talk of getting ready for it. I think today those times have gone. Climate change is already upon us. We see catastrophes with increasing frequency of losses, increasing severity of losses. So obviously that's an area where most reinsurers have lost money in the last few years, right? But 2023, I think reinsurers tightened terms, prices hardened, a lot of so-called free covers that were given. Like for instance, a reinsurer would give an all-risk cover. Today, we don't do that anymore. It's all named perils. So if you want to buy a particular peril, you need to pay for it. So a lot of tightening has happened. I think the markets are becoming better now. But yes, so property is an area which lends itself to reinsurance because the fact that they're all big ticket businesses. So that's an area where you would see a lot of reinsurance capacity being deployed. And well, so naturally, when you deploy more capacity, you would expect more money to come from it.
So if I had to pick your pecking order in which your businesses yield margins, what would it be?
It would be property one. Number one would be property. Second would be some of the specialty classes like liability, maybe marine sometimes. Motor and health, unfortunately, are not very profitable as of today because third-party motor is a bit expensive. But I think India as a market is becoming better. Both third-party own damage is doing well on the loss fronts, but it is the costs that are being very heavy there. Health is now doing decently fine. Obviously, it suffered during COVID. But after that, the good point is people have started buying more. So earlier you would find people just buying a 1 lakh floater cover and saying that they are comfortable. I think COVID has shown them that they need to buy more for it to be more adequate. So that has happened. I think what needs to now happen is more people need to buy, because insurance and reinsurance is a game of large numbers. More and more people buying covers means that you are able to manage the losses better.
So I think the regulator's vision of 2047 would actually contribute.
Oh yes. So I think regulators and governments are pushing very hard.
Yeah.
Insurance for all by 2047, like you said, is something that everyone is working towards. The regulator is also pushing a lot of products, combined products, which will hopefully work well for the rural population because till now, whatever we have done is more for the urban players. We need to get into the hinterland, get into the rural markets. So there is a product called Bima Vistar, which is coming up, which is a combined product which has health, which has life, which is property and PA. And it's meant for people in the rural lands. It is being sold by a set of sellers called Bima Vahaks. Again, women folk from the villages who are supposed to do all this. So a lot of enablement is happening from the regulator's side. From the government side, they have also realized that a lot of people may not be able to afford insurance, but they want insurance to be made available to all. So they are also doing a lot of subsidizing of premium for people who cannot afford.
And how are the margins going to be on these products? I mean, in terms of insurance as well as reinsurance?
Margins might be tight. I mean, we have to accept the fact that if we are bringing more and more people into the fold, initially pricing will be tough, pricing will be less. You will need to manage these portfolios better. So at the end of the day, I think once people realize that, so again, the point being the selling cost might be low, for these kind of products, whereas you find that some of the classes that we are selling today, motor for instance, the acquisition cost is very high. Otherwise the loss ratios are actually doing well. So these are things that we will need to manage as an industry, manage cost so that the products become viable.
Also one closer look at your 9-month numbers, and I was looking at the operating profit, which is around 9% odd, and I think you all had closed last year at around 17%, which was a great number. So how do you look at exiting FY24, and what's your target for FY25?
So when you look at the 9-month, it actually does not give you a complete picture of the year, simply because the last quarter, that is the October, November, December quarter, had 2 cat losses in India. One was the Sikkim floods, another was the Tamil Nadu floods. So both obviously have given us losses also. So that has kind of spiked the loss ratio and the combined ratio. We would normally expect the last quarter to do well, because the Jan, Feb, March quarter is normally the quarter where we don't get to see any catastrophes. Wind events are not there, rain is not there, floods are not there. So that is normally the quarter which works well for us. So we would hope to get the combined back to more reasonable levels. We were at close to 117% for the 9-month. We would hope to come back by around 112, 113 numbers. So I think we are more or less fine with the numbers that we see for this year. Going forward, like I said, there will be growth. We are already discussing with our partners in India, because April to March is when the treaties work. So we are already starting looking at renewals for the next year. We will be definitely writing more business than what we did last year. We are very bullish about the market, about the way things have worked out, the way the insurance players are looking at this market, the way they are managing their own books. So as long as risk management is good, pricing is maintained, I think this market should do well. So I think 25, we would expect growth, and we would definitely expect better profitability.
And so do you have any targets in terms of combined ratio? I mean, some systematic targets for the next 1 year, 3 years. Is there a plan?
There is a plan, and the plan is more long term. For a company like ours, so last year for 23, we finished with 109, right? Now, obviously, a lot of people feel that when you're paying out more than what you're getting as premium, it's a loss-making business. But actually, it's not. Because in the Indian market, the premium comes upfront and the claims happen over the period of time. So obviously, that creates a float in the hands of insurers and reinsurers, which we can invest, and then using that income, we can actually reduce our combined ratio. So last year, our adjusted combined in that sense was 87%. So that gave us a good margin. Now, obviously, from a perspective of ensuring that our combined comes down, we need to ensure that we do it more as a journey rather than a one-stop thing. So currently, as I said, last year we closed at 109. We would want to reduce combined by about 1% each year. But I think that is the only way to ensure that as we grow, our combined remains at a more manageable levels.
So also, I think I've been hearing about the government last year doing a lot of road shows when looking at divestment. What's the update on that front?
So we just completed an international roadshow. Yes, like you said, in October we did a roadshow with domestic investors. There was a lot of interest, and people possibly, as a company, we are not being tracked much simply because we are a reinsurer. We don't have any peers in the local market which people can benchmark against. So there was not much of analytics or data being shared or reports being generated. So we were not being tracked. But ever since we went and met investors and analysts, there's a lot more interest. So last 2 weeks we were traveling abroad with government officials to just again gauge interest from the international community for our stock, and it was quite encouraging. Again, maybe most people were not tracking us much simply because we are a lone reinsurer in the company. But having met them, having given them the idea, having given them the confidence about how our business is looking, we see a lot of interest. Now, whether a divestment will happen will actually depend on the government, because as a company we don't need capital. Against the mandated 150%, my solvency is 294, so I don't need capital. But if you see, there is a SEBI guideline which says that once you are listed, your minimum public shareholding should be 25%.
Yes.
Currently, our minimum is around 14.2. Government has 85.8% stake. So obviously there is a chance for them to reduce another or divest another 10.8% to come to that 75% figure, so that there will be 25% minimum public shareholding. So we believe that could happen, but it depends on the government when they want to do it.
Okay, no discussion with regards to the timeline for
No,
the
not
same?
at all.
Okay. Also, so what now, while you've mentioned that motor and health might not be as lucrative as of now, we also have a lot of private players entering the reinsurance space. We have PB FinTech that's coming in. So do you believe that since the competitive landscape in the country is changing, do you believe that will have an impact on the kind of goals that you've set maybe for yourself, as well as the kind of performance that the company is seeing?
Okay, first the clarification, PB FinTech has not got into the reinsurance space. They have become a broker.
Yeah.
So they have got the broking license for reinsurance, right? So there are enough brokers in the country doing reinsurance as well. So they are just one of them. As regards competition in the market, that competition was always there. I mean, if you look in the past, this was actually a very open market, right? Every reinsurer could write business in this market without having a presence. So a lot of the major reinsurance biggies have been writing this business for a very long time. But in 2015, the regulator actually felt that they needed more stickiness and more commitment from reinsurers because they felt that if they are allowed to write business from where they are, there was always a chance, and we have seen it in the past also, they tend to walk in and walk out of the market. So there is no stickiness, there is no commitment, and from a regulatory perspective, they are not very happy with that because they always worry about what happens to the policyholders. So in 2015, they came out with a regulation saying people who open offices in the country would be given more preferences for writing businesses. So ever since then, about 11 people have opened branches in India. We believe there is a good amount of business available for a lot of reinsurers who are currently writing from outside. The regulator has also brought in regulations now, making it slightly difficult for what we call as cross-border reinsurers. These are reinsurers who don't have a presence in India, but are outside India and writing business in India. So now there is a regulation which says that they have to put collaterals in place when writing business from India. So we believe not many of the reinsurers will be happy with that, and so they might prefer, if they are already writing a lot of business here, they might prefer to open offices in India. We are not worried about competition. We have seen that in every year that we have been in business. So we are not worried about that. We have a great relationship in this market with all the insurance companies. We understand this business very well. So we are fine. We are more than happy to have more competition. We believe it will add to the discipline of the market, improve pricing, improve risk management, improve exposure management, and I think that's going to help the market overall.
So now with the reinsurance business uptake that you've spoken of, in terms of competition overall, you said that it's not going to be y'all are the sole player. But how do you see the right of first refusal has been reinstated yet? But do you see that in the future, if this were to be taken away, would that have any impact on the business? And what is your take on the kind of conversations y'all are happening with the industry?
See, the right of first refusal has been given just to ensure that, a lot of business gets written within the market, gets retained within the market. So that, a lot of business doesn't go out of the market and, stays out, because the regulator has always wanted that premium should be retained as much as possible within the country. So that is where the right of first refusal has come from. Tomorrow, if that goes away, we still do not worry about it, simply because like I said, we have a great relationship with companies. I don't think when we discuss business with any of the insurance companies, we talk to them about the right of first refusal, and so they should show that business to us. That business comes to us because we are good, A. B, because we understand the business. C, because we have that kind of capacities. I don't think many reinsurers today in this market has the kind of capacity that we can put out. So that is the reason why we get business. So I don't believe that's going to be a problem at all.
Okay. And so finally, I would want to ask you about, what sort of plans do you have for the company in the next 1 year?
I think 1 year is too short, because we are planning for this company from a long-term perspective. Idea is tomorrow, once I retire and somebody new comes in, I think the company should be on auto mode and it should do what it is meant to do. I think there are a lot of initiatives that we have put in place. The HR initiative that we have put in, I think it is a game changer. Because, GIC is not a typical PSU where you have thousands of employees, tens of thousands of employees spread all over the country. GIC is a very specific company which has got 435 people in its roles, very lean, We have offices here in Mumbai, which is our main office. We have offices outside the country. So, there's a lot of opportunities for people to go there, get trained, come back. But we also want to ensure that our workforce is one of the, best workforce in terms of quality, in terms of happiness, and they all want to stay with us. Because believe me, being in a PSU in a business like reinsurance, it is very easy for our people to be poached by other reinsurers. But in spite of that, we see a lot of stickiness in our employees because they want to be with us. The working atmosphere here is fantastic. And so that is something that we want to do. So we have put in place some HR initiatives to ensure that our best people stay with us. From a business perspective, I have already explained to you, we are going to grow, but then the growth is going to be with very specific push on our bottom line. Unless there is a significant impact on the bottom line, we will not write that business. Okay. Relationship is something that we are very keen on. In the Indian market, I think we have business relationship with all the companies. We have a fantastic relationship. We can always go, they can always come to us. In case of a claim, they can always come and speak to us. In case they want to write some business for which they don't have capacity, they can always come to us. So that relationship is there, and that augurs well for us. So all these, I think, there are initiatives that we have put in. Our enterprise risk management place is already well done. We are managing our risks very well. Our exposure management is happening. We have a Lloyd's syndicate in London, which we use to, transport a lot of business analytics and I would say a lot of technology that is available in the developed market that we are pushing into the Indian market through them. We are using all that to ensure that our business is good, and when our business is good, our pricing is good, it automatically affects the Indian market positively. So I think these are things that we are doing. I think the market overall should do well.
Thank you so much, sir. It was a pleasure speaking to you.
Thank you, Monal. Thank you for having me.